Hi, it's Christopher Joye here. Just going to give you a quick update on next week's all-important RBA board meeting. There's been some new information in the last 24 hours that has materially altered the financial market's probabilities of a rate cut next Tuesday. And I'll talk you through that information. The first was Terry McCrann, a very prominent columnist for News Limited, published an article overnight arguing once again that the market has got it wrong and that he felt that the chance of a rate cut next week was better than 50-50. Interestingly, I'd actually made a similar argument several weeks ago that the probabilities of a cut in April weren't too low. Now, McCrann raises a new angle himself in his article, and that is that the RBA staff members and the governor of the RBA have been rolled by the circa 6 doves that sit on the RBA board. By way of background, McCrann and I had a running debate for much of last year about the RBA board dynamics. I had argued that there was a division between members of the board and the staff, and I'd argued that the board had rolled the staff on several occasions. One of the outgoing board members, Graham Cray, came out several weeks ago and confirmed this. He confirmed that indeed RBA board members had explicitly rejected staff recommendations for rate positions. They had pushed through stronger rate cuts than had been recommended by the RBA staff, and they'd also held the RBA back from hiking rates, presumably in the first half of last year. Now, McCrann argues, interestingly, that if the Reserve Bank staff recommend unchanged rates next week, he thinks it's more likely than not the board will roll them again and we'll get a cut. Obviously, very important for the housing market. This has really influenced pricing. So we had a rally in bond prices and an increase in the probabilities of a cut next week. That in and of itself is somewhat curious because McCrann has been head-faked and blown up pretty badly by the RBA on 3 or 4 occasions over the last 1 to 2 years. And investors have lost many millions of dollars being incorrectly positioned, most prominently in October 2010, in August last year, and in February, where this year I called obviously a hold, and the market McCrann called a cut, which the RBA didn't pass through. The other major piece of news was this morning I attended a breakfast speech by the Treasurer, Wayne Swan, which was also covered in the media. Parts of the speech had been leaked. And the Treasurer spent a long time explaining why, in short, Treasury had incorrectly forecast government revenues and revenues were not likely to be nearly as high as they had expected. And therefore the task of the government in terms of securing a surplus was going to be significantly more challenging. Swan reiterated the government's commitment to a surplus. He argued that there would, as a consequence, be significantly greater savings sought by the government in order to accomplish that objective. And implicitly, he was arguing that the more contractionary stance of fiscal policy will give the RBA more scope to cut rates. So that was important. Just looking ahead over the next couple of months, the RBA has set up 2 clear decision rules. One is it needs to see a material weakening of demand. Now, on that front, we had a very weak GDP print in the 4th quarter of last year. But both the RBA and the Treasurer today have really dismissed that number. They're both continuing to argue that the economy is running close to trend, that we need to look through that 1 quarter worth of data, that the data is incredibly volatile and subject to huge revisions. In the 1st quarter of last year, the first estimate of quarterly GDP, I think, was negative 1.2%, and that's been revised up to only negative 0.3% or thereabouts. And a lot of the business surveys suggest the economy is growing at trend or close to trend. The other point is that the unemployment rate has remained relatively stable at around 5.2%. So we haven't had the big increase in unemployment yet. That is one condition the RBA would like to be realised in order to put in place more accommodative policy. On the other hand, we have had still fairly soggy housing data. The housing market's in actual raw terms been flat, so house prices have been flat thus far in 2012. But if you seasonally adjust that data, it's probably off a bit. And then, of course, the banks have taken back 10 basis points of the 50 worth of cuts the RBA put in place. And if there were any further out-of-cycle hikes by the banks, that would increase the likelihood of the RBA trying to offset that. The other key decision rule the RBA set up was that it really needs to have an inflation outlook that allows it to cut rates. And the vital point there is that the RBA gets the first quarter inflation data and revisions to all the past data at the end of April, before the May meeting. So one would think there's a strong case for waiting for that information and not trying to preempt it or prejudge it in any way. A final point on the economy is the Aussie dollar is now off 4% from its level when the RBA last met in March. It's currently trading at about 103.8 US cents. So once again, the Aussie dollar, the exchange rate, is doing some of the work for the RBA in terms of the fine-tuning of the economy. Just quickly in closing, my own view is that a cut next week is certainly a possibility, albeit perhaps at this juncture that is today, and I'll revisit my position prior to the meeting, not a probability. The RBA probably needs itself greater visibility on the inflation outlook, and it only has to wait a few weeks to get that, and it can reassess its position in May. The economy itself and consumers would probably benefit from interest rate stability. It's not frankly great having a huge amount of uncertainty about the direction of rates every single month. And the RBA knows it can't over-engineer economic activity with its very blunt rate instrument. The business surveys, whilst they say the economy is travelling close to trend or thereabouts and have actually been improving, are probably underclubbing estimates of growth because of the somewhat flawed weighting systems they use in those business surveys, given we have a very narrow growth base. And then finally, the RBA has expressed significant concern about productivity. It's actually said unless we improve our productivity performance, the RBA is not going to hit its inflation target, and rates will have to head higher. That's it. Thank you.